Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this morning. Of course, if you have any investment questions about an investment you own, maybe about retirement planning, Social Security, send them to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com, for any of our free reports. Sign up for a consultation with my firm. We have offices right here down the street from you in Fort Myers and in Naples. You know, one of the things that I like to always discuss is, of course, the current state of the economy, which is sound. We have a growing economy, a slow growth economy, and we like what we see for this year, and we like what we're going to see for the second half of this year. We think we're going to see a little bit more improvement, not only in the growth of the GDP, gross domestic product, but corporate earnings, which will bode well if you're positioned correctly in your portfolio. Today's topic: what investing behaviors undermine investment performance? One of the big keys to making money with your portfolio, especially for you pre-retirees and retirees, is not having bad investment advice, not having bad investments in your portfolio, and making sure you avoid the behaviors that often undermine the performance of your money. Why you need an adaptive investment strategy to grow and protect your portfolio. This is vitally important. One of the biggest issues I find with most investors is their investment strategy, if they do have one, is not adaptive. Meaning it's not allowed to change when the economy is changing. I'll give you a great example. Remember back in the market crash of 2008, remember the housing boom and bust? Was your strategy adaptive back then? Were you able to navigate the markets? Were you able to make changes to your portfolio to protect your portfolio from major losses? What I find is most investors, your strategy tends to be buy and hold. Maybe not your fault. It could be your Wall Street firm or your bank or the insurance guy who really is not managing your money, but really selling you investments. So if your strategy is not adaptive, you're going to ride the next market recession or crash down another maybe 40, 50, 60%. You probably didn't like that last time. That's why adaptive investment strategy is vitally important, not only today, but for the next 20 or 30 years of your portfolio. Don't make the mistake of spending more time planning your vacation than planning your financial future. This, again, is one of the big ones. I will often have a lot of individuals call my offices after one of my TV or radio shows, and they want a consultation. They'll usually make those calls right after a major problem occurred or right when they actually need to make a choice instead of planning ahead. What you as an investor really need to do is make sure the advice you're getting from your financial professional is advice all the time. They should be coming to you with ideas and things that you need to do ultimately with your portfolio and or retirement plan or strategy so that you can benefit before you have to react. So you want to be really ahead of the game. Your advisor or yourself need to be looking at things now that are going to affect you down the road, maybe 6 months or 2 years down the road, instead of today that are affecting you. Numerous studies show people who are methodical enough to create a written investment strategies can expect to outperform their peers. Let me explain. There's been a lot of studies through various sources, whether it's Morningstar or Delbar. They talk about investment returns and investor returns, your returns, which actually are often much less than what the actual investments are. Again, what is your written investment strategy? If you are having your money managed by somebody, which a lot of our TV and radio show listeners are, what is that strategy? Can your advisor give you a written strategy to show you exactly how they're managing your money? Remember, more importantly, is it adaptive? And what is your risk management strategy within that plan? Do you have one? Unfortunately, investors have no plan often. Neither does your broker. Remember, your broker or so-called advisor at a bank, Wall Street firm, or an insurance guy is really selling you investments. They may use a fancy title of advisor, but if you are not in an advisory account under an advisory agreement, You really don't have a managed account, and you may have no plan at all. So remember that. If you're managing your own money, do you really have a plan? What's your strategy for buying, selling, risk management? How do you protect your money from catastrophic loss, like in 2008 recession? Because folks, we're going to have another recession one day. Are you going to repeat the mistakes from 2008? And remember what your advisor told you back then? Hold on, things will come back. That devastated your portfolio for better than 8 to 10 years until your money came back. So it basically means you made no money. Can you survive another one of those market crashes, or should you have a plan, and should it be adaptive? Making a return on your investments all boils down to two things: knowing what works and actually doing what works. What I find investors often do is they basically buy investments because they heard of them, and unfortunately they hold those investments even when they go down 40, 50% or out of business. Knowing what works, and remember, always doing what works. You as an investor have to make sure that you follow the plan. There are two paths to gaining experience necessary to knowing how to minimize investment mistakes. Remember that. Smart path, by learning from other investment people's investment mistakes. Others' mistakes. You don't want to make those. Learn from others' mistakes so it doesn't wreak havoc on your portfolio. Or the expensive path, the path you don't want to take. Making your own investment mistakes, learning from the school of hard knocks. Again, is your advisor really managing your money? Are you happy with the advice you're receiving? Is the advice you're receiving more sales? If you're managing your own money, are you really doing a great job? And are you happy with those returns? Are the returns on your portfolio meeting your expectations? Maybe it's time you schedule a second opinion consultation with Rezny Wealth Management. Find out the difference why an adaptive investment strategy may be the best thing for your financial security and your retirement. As I've always tried to educate investors, I know change is always difficult, but sometimes a second opinion just to talk is exactly what you need. I'm going to take a quick break. I'll be back with your questions after this short break. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report Sunday mornings throughout Florida. For 30 years, I've helped investors solve their biggest investment and retirement risks. I now see 3 major investment risks that I'm alerting investors about in a groundbreaking free special report. 3 investment risks you must avoid now. If you have at least a $500,000 portfolio, get your free report today. And we're back. Again, send your email questions to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, download that groundbreaking report. This is a recently created report that my firm has put together, and it's vitally important that I believe all investors read this report. Groundbreaking information, 3 big risks I am warning investors about now. That report is available free on my website at ReznyWealth.com. And again, if you have any questions about your portfolio, if you're ready for that consultation, call our office number, visit our website, schedule a consultation, get that needed second opinion you vitally need, and get yourself back on track. Larry from Miami, Florida. What is the difference between a mutual fund and an ETF? Larry, excellent question. First off, ETF stands for Exchange Traded Fund. ETFs have been around for probably close to 20 years. Mutual funds have been around a lot longer. The big difference with a mutual fund versus an ETF is almost in the cost structure. The typical mutual fund, if you look at Morningstar, an independent rating service, says the average mutual fund has an annualized cost structure every year of well over 1% a year. The typical ETF exchange traded fund has an average cost structure about less than half of a tenth of a percent. Which is significantly cheaper, of course, on an annual cost structure. The big difference is ETFs will also mimic various indexes where mutual funds are actively managed most often. Most mutual funds underperform their base indexes, and ETFs typically are mimicking those indexes, so you have a better shot to keep up with those indexes and at a substantially cheaper cost. The big key is, how do you match and mirror which ETFs, exchange-traded funds, in your portfolio and manage those effectively for the growth and income you need? That's really where a professional money management firm comes into play. And again, I always encourage you to call our office for a consultation. We'd love to show you how ETFs can be a vital, important part of your retirement portfolio. Sal from Naples, Florida. Are bank loan funds suitable investments for today's times? Sal, they actually are. Let me explain what a bank loan fund is. It essentially is a floating rate fund, a floating rate bond fund, meaning very short term in nature. Remember, interest rates are at an all-time low over the last 40 years. When interest rates go up, your bond values go down, and vice versa. When rates are this low, as an investor, I realize you're trying to get a decent dividend or interest income on your money. The problem that you, the investor, faces who buys too many bonds or bond-type investments is if rates slowly move up, which we're starting to see this year, your principal value goes down. So your total return could actually be negative because your value goes down and you have this interest. On a floating rate bond fund, because it's so short term, you have less chance for the value to go down, but your interest rates can keep staggering or stair-stepping their way up over a period of time as rates move up. I like bank loan funds today. Don't overload the boat, but it's an excellent investment for somebody who wants to be a little bit more cautious and conservative, wants an income stream, and wants the opportunity for that income stream actually to go up as interest rates go up. Excellent question. Tom from Cape Coral, Florida. What is the role of bonds in a portfolio? Tom, many, many decades ago, people would basically build a portfolio out of stock and bond investments. Today, there are many other asset categories that could be put in a portfolio. But traditionally, the role of bonds were really to give you an income stream and also buffer the volatility of the stock market, because traditionally, when interest rates were much higher and the Fed would reduce interest rates, let's say in a recession, bonds would go up traditionally and equities went down in a recession. So you'd buffer some of your exposure. So maybe your portfolio only dropped 10% instead of 50% by having a bond mixture. The difference today is interest rates are so low, bonds will not give the same heavy lifting measure or protect the stock exposure that they once did. The other problem is rates are moving up. And again, because interest rates are so low on bonds, you're not going to make even near the return you made a decade or two ago on that bond portfolio. So investors ultimately that own too many bonds are going to suffer. As an investor, I recommend a total return strategy, which means growth of principal plus dividend or interest combination. We do a lot of specialization at my firm on growing retirement income for retirees. So if you're concerned about the income you're receiving, if you're concerned about maybe the way your portfolio is being managed or lack of, it's time for a second opinion consultation. Call our number or visit our website, ReznyWealth.com. Sherry from Boca Raton, Florida. What do you think of all the negative headlines about the economy? Sherry, traditionally, there's always going to be negatives and positive headlines about the economy, about geopolitical events. Of course, the big one that's been as of recent is really North Korea. So one of the things you have to understand as an investor, there's always going to be all kinds of news. It usually doesn't really affect the market in the long term. In the short term, you might have a day or a week where you see some of this volatility. You as an investor have to take that negative news or that worthless news and put it aside and not let it affect your portfolio decisions. Unfortunately, what I do find with a lot of investors is you will basically listen to some of this headline news and often react in the wrong way. Just because the market comes down a little bit from negative headline news doesn't mean you should run off and sell parts of your portfolio. The big key is risk management is important, and it is important at our firm in the way that we manage portfolios. But we look at risk management when we have an overheated economy and it starts to slow down and roll over, like in a recession, kind of like we had the recession in 2008 or 2000. We'd be more concerned about that and a slowing economy versus short-term headline news. Todd from Naples, Florida. Are you concerned about interest rates and bonds? Yes, I talked a little bit about this earlier. Remember, when interest rates go up, bond values go down and vice versa. So it's kind of like a teeter-totter effect. What you have to understand is bonds are at about a 40-year low. If rates move up just a little bit, bond values drop. It means that you lost principal. Sure, you made some interest, but at the end of the day, your investments may be actually worth less than what you started with. Investors are going to have to change the dynamic of their portfolio. Earlier in this show, I talked about adaptive. At my firm, we believe in being adaptive with our investment strategy. Times are changing, folks. The way that you had your money invested maybe a decade ago is not the way maybe it should be invested today. Unfortunately, I think a lot of investors get caught up in a lack of change, meaning when change is appropriate for your portfolio, your broker's not doing it right, or they're not doing it at all. So traditional investing, to me, is changing, and you, the investor, ultimately need to change the way your portfolio is constructed. Ted from Fort Myers, Florida. This bull market is long in the tooth, as many claim. What do you look at for the end of the bull market and a pending recession? You know, first off, this bull market has been one of the slowest economic recovery, really probably since World War II. So we don't have an overheated economy. Ted, the big thing you want to look at is every time we've had a recession, it's been from excess in the economy. 2000, as an example, is an excess from technology stocks going up too fast, too much, and being overvalued. If you look at 2008 recession, that occurred because of the housing market was overheated. People were building things they couldn't afford and buying things they couldn't afford. So if you look at excess, that really leads into a recession. We're not seeing that currently. That doesn't mean it may not change in 6 months or 6 years or sometime in between. I firmly believe this. The economy's on a growth spurt. We're growing GDP north of 2%. We should be growing quicker. I believe a lot of the policies that our current administration is trying to implement will ultimately help the economy, and we're starting to already see signs of that today. I think investors, in my personal opinion, are over-invested in bonds. I think they are underinvested in certain types of equities, and I would be diversified. But I think ultimately investors are in the wrong areas at the exact wrong times, and investors are nervous because they saw their portfolio drop 2 different times 50% in 2000 and in 2008. That's, again, why I go back to adaptive. Is your strategy adaptive? Has your advisor given you proper advice on risk management? If they haven't, it's probably time for a second opinion consultation with Rezny Wealth Management. I'm going to take a quick break. I'll be right back with your questions after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report Sunday mornings throughout Florida. For 30 years, I've helped investors solve their biggest investment and retirement risks. I now see 3 major investment risks that I'm alerting investors about in a groundbreaking free special report. 3 investment risks you must avoid now. If you have at least a $500,000 portfolio, get your free report today. Hello, we're back. We're talking a lot about adaptive investment strategy, the economy, the markets. how you should be invested as a pre-retiree and a retiree, make sure you visit our website, reznywealth.com. I know that we get a lot of calls after our shows, especially at the beginning of the week on Mondays for consultations. Remember, we have offices right here in Naples and in Fort Myers. If you have any concerns about the advice you're getting, the direction of your portfolio, give us a call. Schedule a consultation. We always enjoy working with nice people who want to improve their financial situation. Maybe it's time you receive that second opinion, that overview of what you're doing to make sure that you're not leaving some chips on the table, or maybe some of the advice you're getting is not quite right, so you can get yourself back on track. Call Rezny Wealth, and of course visit our website, reznywealth.com. Lori from Cape Coral, Florida. There's been a lot of constant talk about China's economic hard landing that never really seems to appear. Do you like China as an investment? I like the emerging markets as an investment currently. That may change in a month or 6 years down the road. Again, we adapt and we will make adjustments in our client portfolio. We do not believe in blindly buying an investment and holding it. But as for China, they've talked about China's hard landing for years and years. Mostly Wall Street firms. And by the way, these Wall Street firms are the same ones that have always been wrong about recessions, about China's hard landing. They've talked about recessions the last 3 or 4 years, and again, those have not appeared either. Personally, I like the emerging markets. They are undervalued in our opinion. They're a great opportunity for part of your portfolio, but be diversified. I would not pick just China if you're trying to be a little bit more cautious on your emerging market exposure. Look at more of a broad-based emerging market ETF. I think that's a better opportunity. Instead of picking one country that may do well or not, pick a broad basket in an ETF that basically allows you to be well diversified within your portfolio. I can tell you currently at our firm, we like the valuation of emerging markets. We believe that there's opportunity for the longer term. Again, expect a little volatility, but I think the growth potential could potentially be there for investors who are wise and position themselves correctly. Sam from Fort Myers, Florida. Can strong corporate earnings spark a renewed rally in stocks? Sam, yes, we're already seeing that in this year of 2017. Corporate earnings have been on a tear. The couple years previous to this year were a little lackluster. Remember, corporate earnings don't always grow 8 or 10% every year. You could have a year where they go up 1 or 2%. You could have a year corporate earnings are down 1 or 2%. But over the longer term, if GDP, gross domestic product, we're expanding, we've got moderate inflation, I firmly believe corporate earnings are on a rise. I think next year's comparisons will be a little tougher because this year's are pretty good. But generally speaking, remember this, if corporate earnings are rising, that typically bodes well for stock values going up, or the opportunity of. If corporate earnings are coming down, that usually means stocks are probably going to stall or come down to some extent. Long-term, corporate earnings have expanded over decades and decades and decades. I do not think that's going to change anytime soon. And again, are you positioned correctly, or are you overweight the wrong areas of the investment landscape? And I see that too often with a lot of investors out there. So if you have questions about your portfolio, if you're concerned about the direction of your money, call my firm for a consultation. Let's talk. Let's discuss. Let's get you back on track. It doesn't hurt to talk and get a second opinion. Robert from Bonita Springs, Florida. Please explain managed futures, and do you think they are good investments? Robert, first off, I would never, ever, ever buy a managed futures fund. Wall Street firms love to sell these because they pay them lavish commissions and fees. So first off, anything that Wall Street likes to sell is typically not good for your portfolio, especially when a commission is involved. Managed future funds. Performance of most of the funds that I've looked at over the years, mediocre at best, volatility, high expenses. I would stay away from managed future funds. They make 0 cents in your portfolio. If you own one, chances are it's probably not doing well. Another reason to call my firm for a consultation. If somebody's trying to sell you a managed futures fund or an alternative fund, as they are often called, it probably means you're working with a brokerage firm or Wall Street, under suitability. Their interests are not the same as yours. Avoid managed futures funds. Do not be sold if you care about your wealth and at least preserving it or having the opportunity to grow it. Dean from Miami, Florida. Do you consider geopolitical threats when making investment decisions? Dean, no, I do not. Geopolitical events is a good example. You know, this year the big one, of course, is North Korea. I do not. We've had geopolitical events for obviously centuries. That's nothing new, nothing different. We're going to have geopolitical events next week, next year, and 10 years from now. They're always going to come. They're always going to go. What you have to realize is it may be a great opportunity for you to invest money. Anytime you get a geopolitical event, often what you're going to find is the market might come down for a day, a week or so, and it might be a great opportunity to add some money or reposition your portfolio in assets that maybe are not where they should be. But geopolitical events in themselves are natural occurrences and not something that you should be scared about. One of the things that I want to talk about before the end of this show is really financial security and the well-being of your money. As an investor, you've got a couple choices to make in life. One of those choices are, is your portfolio being managed properly, and is it meeting your goals and objectives? Number two, if you're not happy with the advice you're receiving, how long do you wait? I get that question a lot. Often people that come into our offices right here in Naples and in Fort Myers will say, Brian, I've listened to your TV or radio show for many years. I should have come in years ago. I knew the advice we were getting didn't seem right. I didn't feel that the person was really working in our best interest, but it was hard to make that change. And I always realize that because change is very emotional. You, the investor, have to realize this. You have one retirement and you have one portfolio. Never settle for bad investment advice, ever. Your retirement security and your family's financial security is vitally important. It should be to you. The advice you get could have a very bad impact on your family security and your retirement. So think about that. So again, if what you're doing is not working or the advice you're getting is not right, we want to give you results, retirement security, peace of mind. Experience the Rezny Wealth Management difference. My advice, never settle. Get a second opinion. Call us today. Schedule a consultation. Our office number is on the bottom of the screen. But make sure you do visit our website, reznywealth.com. Schedule a consultation either there or by calling our office number. And make sure you download any of our groundbreaking reports. The current one, 3 big investment risks you must avoid now. That report is currently free on my website. It's a must-read for any pre-retiree and retiree. We'll see you next week.